Ending the week with an improvement with interest rates. Now, we had a lot of data that came in that was bond friendly. You had inflationary data. CPI was right in line with expectations, but PPI, this is the front end of the equation, what the producers pay, it came in lower than expectations. Retail sales came in lower than expectations. Consumer sentiment came in lower than expectations. Manufacturing came in much lower than expectations. Jobless claims pretty much are right on track. And then, of course, you have the ongoing saga of what is going on with these small banks. And all of these things are positive for the bond market because it leads us to believe next week when the Fed meets on Wednesday that they're not going to be raising 50 basis points. It's going to be most likely 25 basis points, but maybe even nothing at all. Now, the ECB, they telegraphed well in advance that they were going to be raising their rates 50 basis points. They did stick to it. Very hawkish comments. We'll see what comes of it as we move forward. But in the meantime, you've got all of these bailouts that are occurring. Small banks, they invest in a lot of times long-term bonds. And when you have interest rates go up so quickly, it loses their position of value. And so when their stock goes down and they have to liquidate, that's where they get in trouble. You have a lot of these large retail banks. They have more diversification and they have just a ton of money in reserve. So much so, a lot of them put $30 billion over into First Republican Bank to make sure that it stays solvent moving forward. But these are all very exciting times. We'll keep an eye on it. But for the most part, it ended the week with an improvement in interest rates. You guys be safe, and I'll talk to you soon.